Welcome to Market Nerd, where seasoned analysts break down listed companies on the Philippine Stock Exchange. Don't forget to like, subscribe, and hit the bell to get the latest developments and investment ideas in the financial markets. Let's dive in.
We always love a good set of financials,
Oh, yeah.
and you've really outdone yourself this
I
time.
have.
This is a really interesting deep dive we're doing today into a company called OceanaGold Philippines Incorporated.
Oh, wow. That's a mouthful.
Yeah, everyone knows it as OGP,
OTP.
and they are the company that operates the Didipio Gold and Copper Mine up in the Philippines,
I'm up in the Philippines.
up in the mountains of Luzon Island.
Yeah.
Wow.
Very cool.
So interesting company. They actually started way back in '96
Oh, why? 96?
as a company called Australasian Philippines Mining.
Australasian.
Australasian Philippines Mining.
Yeah.
But then they changed their name in 2007 to OceanaGold Philippines, Inc.
Okay. So fairly.
And they're a subsidiary of OceanaGold Corporation, which is listed on the Toronto Stock Exchange.
Interesting. Okay.
And they have this really interesting agreement with the Philippine government called the FTAA,
FTA.
which is a Financial or Technical Assistance Agreement.
Oh, so it's like a...
And this thing got renewed back in 2021,
Interesting.
all the way until 2044.
Wow. That's a long time.
Yeah, so that's a pretty good deal for them.
It sounds like it.
And it basically lays out how they share their net revenue with the Philippine government with the 60-40 split.
60/40 split. Wow.
Yeah.
Okay. And so they've been in commercial production since 2013. Is that right?
Yeah, they hit commercial production back in 2013.
Okay.
And they are actually, right now, they're extracting ore from, they've got underground operations,
Okay.
and they've got these surface stockpiles.
Mm-hmm. Okay.
So it's sort of like a two-pronged approach to getting that ore out of the ground.
And so they've got all these surface stockpiles. Are they processing that, or are they just keeping it in reserve?
Oh, yeah, though they're processing that.
Oh, wow.
Yeah, they've got a processing plant with a capacity of about 4.1 million tons per annum.
Okay, so they can churn through a lot of material.
Yeah.
And what are they're outputting gold doré and copper concentrate? Is that right?
Yeah,
Okay.
exactly.
So for today's deep dive, then, our mission is to really look into how OGP's financial position has changed over the past few years.
Yeah.
We've got these SEC filings.
Yeah, and we're going to be focusing primarily on the balance sheet,
The balance sheet.
income statement,
Yep.
and the cash flow statement.
So the big three.
Big three, absolutely, yeah.
Okay.
And primarily we're going to be comparing 2024, 2023, and 2022.
Okay, so fairly recent changes then.
Yeah, very recent, yeah.
And in addition to those financials, are we going to be looking at any management commentary or...
Yeah, absolutely. We're going to be looking at the risks that management is highlighting,
Okay.
future opportunities that they see, as well as their outlook overall.
Very cool.
And for those of you listening who might not be as familiar with reading through financial statements,
Right.
don't worry, we're going to be your guides today.
Yeah, we'll break it down.
Yeah, we're going to break it down.
Make it easily digestible.
Exactly. So where should we start? Where do you want to start with this whole thing?
Well, a good place to start with any company is the balance sheet.
Okay.
And that gives us a snapshot
The snapshot.
of what they own, so their assets.
Right.
What they owe, so their liabilities.
Okay.
And the difference between those two, which is their equity
That makes sense.
at a specific point in time.
At a specific point in time.
Usually the end of the year in this case.
Okay, so let's start with the assets then.
Okay.
So their total current assets decreased by about 7% from 2023 to 126.7 million as of December 31st, 2024.
Okay, so a slight decrease there.
Yeah.
What was the main driver behind that change?
So the biggest driver was a pretty big decrease in their receivables.
Okay.
$46.7 million to be exact.
Wow. That's significant.
And this is largely just due to like the timing of when they collect payments from customers.
Okay, so it's not necessarily a bad thing.
No, not necessarily a bad thing.
It just depends on when those invoices are going out and when they're being paid.
Exactly. Now this decrease was partially offset by an increase in cash of about $33.7 million.
So their cash position actually improved.
Yeah.
Okay.
So it means that they've got a little bit more flexibility.
A little more flexibility.
Yeah, to weather any storms that might come up.
Right.
So,
Okay.
pretty good position to be in there
Yeah,
at
absolutely.
the end of 2024.
Now, when we talk about receivables, are these mostly trade receivables or are there other components?
Yeah, primarily trade receivables.
Okay.
So it's money owed to them from the sale of their copper concentrate and their gold doré.
Okay, so it's related to their core business activities.
Absolutely. Yeah. Um, and it's worth pointing out, too, that they did have to recognize what's called a provision for impairment of $656,343.
Okay, and what exactly does that mean?
So basically, a provision for impairment means that they're acknowledging that they may not be able to collect the full amount
Oh,
of the
okay.
receivable.
So they're setting aside some money just in case they don't get paid.
Exactly. So,
Yeah.
sort of like a bad debt expense.
Makes sense.
And this was on a receivable from a related party.
A related party, okay.
So it's worth pointing that out.
Now, in addition to that big swing in receivables, were there any other notable changes within those current assets?
Yeah, I noticed some movement in their prepayments.
Okay.
Things like insurance that's paid in advance.
Right.
Prepaid taxes with TCCs.
TCCs.
Tax credit certificates.
Okay.
And also advances that they made to suppliers.
So just sort of the normal ebbs and flows of those short-term accounts?
Yeah, exactly.
Okay.
And there's also an account called deferred input tax.
Deferred input tax.
Yeah. Oh, interesting. And there were some ups and downs there.
Okay.
But one interesting thing I noticed was that in 2024,
Yeah.
they had to write off about $15,243 worth of those TCCs.
Oh, wow. And why was that?
They expired.
Oh, they expire.
Expired, yeah.
So those tax credits are no longer usable.
No longer usable.
So essentially money down the drain.
Yeah, basically, yeah. So those tax credit certificates, they're essentially like vouchers that they can receive from the Bureau of Internal Revenue.
Okay.
And they're often linked to VAT refunds, value-added tax refunds,
Okay.
and then they can use them to offset their future tax liabilities.
So it's a way to reduce their tax burden.
Exactly.
Exactly.
So letting them expire
Yeah.
means losing out on that potential tax benefit.
Right. So that's definitely something they would want to avoid in the future.
Yeah.
Okay. So moving on from the current assets then,
Yeah.
what about their non-current assets, the longer term stuff?
Yeah, so non-current assets, these also decreased by about 6% to $572.7 million at the end of 2024.
Okay. So still a decrease, but not as significant as the current assets.
Yeah, and there were a few factors here.
Okay. What were those?
Well, so first of all, they had a $17.5 million decrease in inventories, but this is net of the current portion.
In net of the current portion. Okay.
Yeah, so meaning the inventory they expect to hold for longer than a year.
Okay. So the longer term inventory.
Exactly.
Oh, Joe.
And then they also had an $11.9 million decrease in their deferred income tax asset.
Deferred income tax asset. So what is that again?
So that's a little bit complicated, but
Yeah.
essentially it represents taxes that they've already paid or overpaid
Okay.
that they can use to reduce their future tax obligations.
So it's like a credit they can use later on.
Exactly.
Yeah.
And then there was also an $8 million decrease in other non-current assets,
Other non-current assets.
which includes a variety of long-term items like deposits and their mine rehabilitation fund.
Oh, the mine rehabilitation fund.
Yeah.
That's an important one for a mining company.
Yeah, so I noticed that they made a deposit of $305,000 into it in 2024, bringing the total up to $6.71 million.
Okay, so they are consistently contributing to that fund,
Yeah, they are.
which is good to see.
Yeah, absolutely.
Now, earlier we were talking about input VAT claims.
Yeah.
What about that reclassification that was mentioned?
Yeah, so that actually happened in 2023.
Okay.
They reclassified $25.77 million in input VAT claims
Okay.
from earlier years, and they moved them into mining assets.
Okay, and why did they do that?
So under their FTAA, those are considered recoverable costs.
Oh, okay.
And they're being amortized over 13 years, starting from the date of the FTAA addendum.
Okay, so basically they're spreading out the recognition of those costs over a longer period?
Exactly. Yeah.
Okay, and finally, let's talk about the big one for a mining company, their physical assets.
Oh, yeah. Property, plant, and equipment.
Property, plant, and equipment.
So this includes all of their essential mining equipment,
Right.
the processing plant where they refine the ore,
Okay.
and also right-of-use assets.
Right of use asset.
Yeah, so those are assets that they don't own outright,
Okay.
but they have the right to use.
Okay, so like leased equipment or building.
Exactly, yeah. So things like buildings and office machinery
Makes sense.
that they might be leasing.
Okay, so that covers the asset side of the balance sheet.
Yeah.
Let's move on to the liabilities now.
Yeah, what do they owe?
Exactly what are their obligations?
All right, so on the liability side, the report provides a brief overview of their trade payables and other current liabilities.
Okay.
And those are their short-term obligations, typically due within a year.
Right, so the bills that need to be paid relatively soon.
Exactly.
Yeah.
Um, and then for their non-current liabilities, they primarily discuss lease liabilities.
Okay.
Again, net of the current portion.
So the long-term portion of their lease obligations.
Exactly. Yeah, but there were a couple of pretty significant accrued liabilities.
Oh, accrued liabilities.
Yeah, and these relate to royalty claims.
Oh, royalty claims.
Yeah.
Now that could be significant,
Yeah, it definitely could be. Yeah.
potentially impacting their profitability down the line,
Absolutely.
regardless of how well they do operationally.
Yeah.
Okay, so tell me about these royalty claims then.
So as of December 31st, 2024, they had accrued $62 million.
Wow, that's a lot.
Yeah, related to a royalty ownership claim by a third party.
Okay, so someone else is saying they're entitled to a portion of the revenue.
Exactly, and this is tied to an ongoing legal matter.
Oh, so it's not even resolved yet.
No, it's not resolved yet.
Okay.
And on top of that, they've accrued an even larger amount.
Even larger.
$69.6 million.
$69.6 million.
Related to the addendum claim owners.
Okay, and who are those?
So this covers both royalties, which are a percentage of revenue or profit paid to the original claim owners,
Okay.
and what's called a free carried interest.
A free carried interest.
Yeah, and that's basically a share of ownership or profits
Okay.
without the obligation to fund it up front.
Wow, so they're entitled to a piece of the pie without having to put up any money.
Exactly.
Okay, so these accrued amounts represent management's best estimate of what they might have to pay in the future.
Yeah,
But it all hinges on the outcome of those legal proceedings.
exactly.
Okay, now moving on to equity.
Yeah.
So that's the owner's stake in the company.
Yeah, what's left over after you subtract the liabilities from the assets.
Right.
So total equity actually decreased by 7% from 2023 to $564.4 million as of December 31st, 2024.
Okay, so a decrease in equity.
Yeah, but the real story here is the massive increase in the number of common shares outstanding.
Oh, wow, a massive increase.
Yeah, it went from 577.5 million shares to 2.28 billion shares.
Wow, that's like a four-fold increase.
It's a huge increase.
What happened there?
So there were a couple of big events in 2024 that caused this.
Okay, what were those?
So first, in February, their parent company, OGPHI,
OGPHI.
subscribed to a whole bunch of previously unissued shares,
Okay.
1.7 billion shares.
1.7 billion, wow.
Yeah. And then in May of 2024,
Yeah.
OGP completed its secondary offering and public listing on the Philippine Stock Exchange.
Oh, wow, so they went public
Yeah, they went public.
in 2024.
Yeah.
Okay.
And in that offering, they sold 456 million existing shares,
Yeah, okay.
which was about 20% of their outstanding shares at that time,
Okay.
for a price of 13.33 Philippine pesos per share.
Okay, so that influx of new shares from the public offering explains the big jump in shares outstanding. Okay, so what happened to the book value per share with all these new shares?
So with all these new shares in circulation, the book value per share naturally decreased.
Right, because you're dividing the same equity pie by a much larger number of shares.
Exactly.
Yeah.
So it went from 1.05 in 2023
Yeah.
down to just 0.25 in 2024.
Okay, a significant drop.
Significant drop, yeah.
And were there any costs associated with that public listing?
Yeah, so they actually had to incur transaction costs
Okay.
of $10.97 million,
10.97 million, okay.
directly related to that secondary offering and public listing.
Okay, so that would have been an expense for them.
Yeah, absolutely.
That paints a really clear picture of the changes on their balance sheet.
Yeah.
So let's shift gears now and look at their income statement.
Yeah, how did they actually perform financially?
Exactly. How did they make money and what were their expenses?
Okay, so let's start with revenue.
Okay.
So their revenue actually decreased in 2024 compared to 2023.
Okay.
But interestingly, it was higher in 2024 than it was in 2022.
Oh, so a bit of a mixed bag there.
Yeah, a little bit of a roller coaster.
So where does their revenue come from?
So their revenue streams come from the sale of gold,
Okay.
copper,
Makes sense?
and to a lesser extent, silver.
Okay, so they've got multiple revenue streams.
Exactly. And they sell these metals in two primary forms.
Okay. What are those?
As gold doré,
Gold doré.
which is that semi-pure gold we talked about,
All right.
and as copper concentrate.
Okay.
And they also mention the impact of provisional pricing adjustments.
Provisional pricing adjustment.
Yeah, particularly for their copper concentrate sales.
And what are those adjustments for?
So basically, it's like an initial estimated price at the time of sale,
Oh, okay.
but the final price is determined later
Okay.
based on average market prices.
Okay, so it's like a floating price.
Exactly.
Gotcha.
During a specified future period.
Makes sense.
And, talking about selling copper concentrate,
Yeah.
I did notice that they changed their agreements there.
Oh, they did? Okay, what was the change?
They entered into a new concentrate offtake agreement with a company called Transamine SA.
Transamin SA.
And this started on April 1st, 2024.
Okay.
And this actually replaced their previous offtake agreement with Trafigura Pete, Ltd.
So a new customer for their copper concentrate.
Exactly.
Yeah.
Interesting.
So let's talk about expenses.
Okay, the cost of generating all that revenue.
Yeah. So the cost of sales, which includes all the direct costs associated with mining and processing the ore.
Okay.
They said that typically the main components are labor,
Okay.
raw materials,
Right.
and energy consumption,
Makes sense.
which all makes sense for a mining company.
Absolutely.
Now, what's interesting, though, is that they also include projects related to their Social Development and Management Program, or SDMP,
SDMP.
within the cost of sales.
Okay, and what are those projects about?
So these are initiatives designed to benefit the local communities affected by their mining operations.
So it's part of their corporate social responsibility.
Exactly.
Yeah. And I also noticed that they had a pretty big jump in general and administrative expenses in 2024.
Oh, big jump in G&A.
Yeah.
Okay, what caused that?
The main reason for that increase was the inclusion of those transaction costs related to their secondary offering and public listing.
Oh, right.
So that $10.97 million we talked about earlier,
Okay.
that got included in there.
So it's a one-time expense.
Yeah. It's a one-time expense.
Okay, that makes sense.
Yeah.
Now, what about their finance costs?
Oh, yeah. So their finance costs actually decreased quite a bit in 2024.
Oh, a decrease in finance costs.
Yeah.
Okay, and why was that?
Primarily because they fully repaid their related party loan during the year.
Oh, okay, so they no longer have that interest expense.
Exactly.
Yeah.
So when we look at all of those revenues and expenses together,
Yeah.
how did their income before income tax change over these 3 years?
So their income before income tax did fluctuate.
Okay.
In 2024, it was $65.8 million.
Okay.
In 2023, it was lower at $44.7 million. And then in 2022, it was actually the highest of the 3 years at $73.8 million.
Oh, wow.
So we see a decrease from 2022 to 2023,
Yeah.
and then a rebound from 2023 to 2024.
Yeah. Okay.
And how about the actual income tax expense or benefit?
Yeah. So the provision for income tax, benefit from income tax.
Yeah.
This also varied.
Okay, how so?
In 2024, they had a provision for income tax of $35.5 million,
Okay.
meaning they expected to pay that much.
Right.
In 2023, it was lower at $17.9 million.
Okay.
And in 2022, it was $18.9 million.
Okay.
So the report mentions that they were able to utilize some carried forward tax losses.
Carried forward tax losses.
Yeah.
And what are those?
So basically, these are previous losses
Okay.
that they can use to reduce their current tax liability.
So it's a way to offset their current profits with past losses.
Exactly.
Interesting.
So kind of like a tax benefit.
Right.
So what was their final net income for each of those years?
So net income, which is their bottom line profit, was $30.3 million in 2024,
Okay.
$26.8 million in 2023,
Okay.
and $54.9 million in 2022.
Okay.
So similar to the income before tax, we see that dip from 2022 to 2023,
Yeah.
and then a slight increase from 2023 to 2024.
Yeah. Okay.
Now, what about their total comprehensive income?
Yeah, I noticed a line about the remeasurement of retirement benefits there.
Oh, right. So total comprehensive income includes not just the net income, but also other things that bypass the income statement and go straight to equity.
Okay.
And that remeasurement of retirement benefits is one of those things.
Okay, and what is that exactly?
It reflects changes in the estimated future cost of their employee retirement plans.
Okay.
So for 2024, total comprehensive income was $30.3 million.
Go ahead.
In 2023, it was $26.4 million.
Okay.
And in 2022, it was $54.9 million.
Okay.
And the impact of that retirement benefit remeasurement was a small loss in both 2024 and 2023.
Interesting.
Okay, and finally, for the income statement,
Yeah.
the report mentions their actual production and sales volumes for gold and copper.
Yeah, what were those?
So for 2024, they produced 97,000 ounces of gold and 12,300 tons of copper.
Right.
And their sales for that same period were slightly higher for gold
Right.
at 100,400 ounces.
Okay.
And slightly lower for copper at 11,700 tons.
Interesting.
Okay, so we've looked at the balance sheet.
Yeah.
We've looked at the income statement.
Yeah.
Now let's move on to the cash flow statement,
The cash flow statement.
which tracks the actual cash moving in and out of the company.
Right.
So when we look at the cash flow statement, the most striking thing is that increase in their ending cash balance
Yeah.
from 2023 to 2024.
Huge jump.
They finished 2024 with $50.77 million in cash.
Okay.
And that's up from just $17.03 million at the end of 2023.
Wow. So that really emphasizes that point about their improved liquidity.
Exactly. Yeah, they're in a much stronger cash position now.
So what were the main activities that fueled that jump in cash?
Well, without going line by line, we can look at the three main sections of the cash flow statement:
Okay.
operating activities,
Yeah.
investing activities, and
Yeah.
financing activities.
Right.
So from a financing perspective, the proceeds from that share issuance we talked about
Yeah.
played a big role in boosting their cash reserves.
Okay.
And then on the other side of the coin, the full repayment of that related party loan
Right.
would have been a significant outflow of cash
Yeah.
in 2023.
Okay.
And then those changes in receivables we talked about
Yeah.
also have a direct impact on the cash generated from their operating activities.
Okay.
So the fact that they collected more of what was owed to them in 2024 brought more cash into the business
Makes sense.
from their core operations.
Yeah. Okay.
Now let's talk about what the management team themselves are highlighting,
Yeah.
starting with the risks.
The risks.
So the report has a whole section on risk factors,
Okay.
which is standard for SEC filings.
Right.
One of the key risks they point out is the potential for them to miss their production targets.
Okay. So not being able to get enough gold and copper out of the ground.
Exactly.
Yeah.
And achieving those targets is obviously crucial for their overall success.
Absolutely.
And they also talk about the uncertainty around their cost estimates.
Yeah. The capital expenditures and the operating costs.
Exactly. So they acknowledge that those estimates might not be accurate.
Right. And they list a lot of factors that could cause that.
Yeah, a whole bunch of factors.
Yeah.
Things like changes in the grade of the ore,
Yeah.
unexpected operational issues,
Okay.
delays,
Yeah.
supply chain problems,
Right.
changes in government regulations,
Yeah.
and even the outcomes of those legal proceedings we talked about.
So a lot of moving parts there.
A lot of moving parts
Yeah.
that could impact their costs.
What about external factors like commodity prices and exchange rates?
Yeah. So they also highlight the risk of increases in costs and tariffs,
Oh, wait.
fluctuations in the market prices of metals,
Yeah.
and in the exchange rates between the US dollar and the Philippine peso.
Okay.
They also mention the possibility of labor shortages
Right.
and the availability and cost of construction services, equipment, and supplies.
Yeah. All very important for a mining company.
Absolutely.
What about their ability to maintain their current operations and potentially expand in the future?
So they do mention the risk that they might not be able to maintain,
Yeah.
improve, or successfully complete the development of their various mineral projects
Okay.
on time and within budget.
So projects getting delayed or going over budget.
Exactly.
Yeah, that's always a risk.
And this could be due to changes in the economic viability of those projects.
Okay.
Problems with equipment deliveries,
Yeah.
unexpected cost overruns,
Right.
or even limitations in their workforce or internal systems.
Well, a lot of things that could go wrong.
Definitely.
Now, you mentioned commodity prices earlier.
Yeah.
That seems like a particularly big risk for a company that's so dependent on mining.
Yeah, absolutely.
Yeah.
They say that movements in commodity prices create uncertainty
Yeah.
in the costs of exploration,
Mhm.
development, and construction activities.
Yeah.
And these price fluctuations can also impact the demand and cost of the various services and equipment they need.
So if the price of gold or copper drops suddenly,
Yeah.
that could really hurt their profitability.
It could.
Yeah.
And as we talked about earlier, those changes in exchange rates can also have a big impact.
Yeah, because they sell their products in U.S. dollars,
Right.
but incur a lot of their costs in other currencies.
Exactly.
Yeah.
So they're exposed to that currency risk.
What about the global economic situation in general?
So they do list the increased uncertainty in the global economy,
Okay.
including the potential for trade wars and tariffs
Yeah.
as a risk factor.
Okay.
And even though they don't directly export to the U.S.,
Right.
the broader economic consequences could affect global capital markets,
Yeah.
commodity prices, and their ability to secure financing.
Yeah. That makes sense.
They also mention potential disruptions in global supply chains as a concern.
So a lot of external factors to worry about.
A lot of external factors.
Now let's talk about the inherent risks of mining itself.
Yeah, mining is a risky business.
Yeah. It's not without its dangers.
They mention things like geological challenges,
Okay.
technical difficulties in the mining and processing operations,
Right.
logistical hurdles in transporting materials,
Yeah.
and compliance with all the complex regulations.
So a lot of operational risks to manage.
Definitely.
Now, the mine life is currently projected to end around 2035.
2035.
Yeah.
So finding and developing new mineral reserves must be a top priority.
Yeah, absolutely.
They say that the failure to replace their existing mineral reserves could have a significant negative impact on their business.
So they need to keep finding new deposits to mine.
Exactly, if they want to stay in business.
Now, we also need to talk about the regulatory and social environment in the Philippines.
Yeah, that's a crucial aspect for any mining company.
So they highlight the risk of failing to meet the requirements for
Yeah.
or to renew their licenses and permits.
Okay.
And they also mention that complying with increasingly strict safety,
Right.
health, social, and environmental.
Liked what you heard? Drop a comment, like, and share this episode. Hit subscribe and tap the notification bell. We've got more insightful market ideas coming your way. Catch you on the next one.